All right, today we're going to dive into one of the wildest, most controversial mergers in the history of tech. HP's gigantic, multi-billion-dollar buyout of Compaq. This is a story that literally reshaped the entire industry.
So here's the big question, the one people in business school still argue about. Was this a brilliant, visionary move, or just a massive, value-destroying blunder? You've got people on one side calling it genius, and on the other, a flat-out disaster. So what was it? Let's get into it and break down what really went down.
Okay, so let's set the scene. It's 2001. Out of nowhere, HP drops an absolute bombshell. They're buying their rival, Compaq, for a staggering $25 billion. The idea on paper was to become this absolute powerhouse that could finally take on giants like IBM and Dell. But, and this is where it gets juicy, this was anything but a smooth ride. HP's own board was split right down the middle, and shareholders were in open revolt. It got so heated that Walter Hewlett, the son of the company's co-founder, launched this huge, very public proxy fight to kill the whole deal.
So you're probably thinking, with all that drama, why on earth did they push forward? Well, to get that, you've got to look at the plan they were selling. Because on paper, man, it looked good. It really did.
The whole thing really came down to one huge, eye-popping number. $2 billion. That's how much they promised to save in costs every single year. I mean, that number alone was the rock-solid foundation for the entire deal.
And this whole grand plan was wrapped up in this one very powerful and, let's be real, super seductive buzzword, synergy. You hear it all the time with mergers, right? It's that magic little idea that 1 + 1 can somehow equal 3, that this new combined company is going to be way more valuable than the two were on their own. Now, they were banking on two very different flavors of synergy. First, you've got cost synergies. That's the easy stuff, right? You combine factories, get rid of duplicate jobs. You can actually count that money. But then you have revenue synergies, and that's way more of a dream. The hope that you can cross-sell stuff. And honestly, that little difference between what's real and what's a dream, that's at the heart of this entire story.
So yeah, the plan looked fantastic in a boardroom on a PowerPoint slide. But there were these two massive, critical flaws just hiding in plain sight, kind of like cracks in the foundation, just waiting to bring the whole house down.
Okay, flaw number 1, a total strategic mismatch. Think about it. HP had this golden goose, right? The printer business. It was an absolute cash cow, just printing money with insane profit margins. Compaq, they were kings of the PC world, but that's a knife fight in a phone booth, a brutal, low-margin game. So the danger was huge. This merger would force HP to spend all its time and energy on the tough, low-profit business, basically ignoring its own golden goose.
All right, flaw number 2, and honestly, this one might have been even more dangerous, because it wasn't about spreadsheets, it was about people. We're talking a massive, toxic culture clash just waiting to happen. I mean, you couldn't find two more different companies. HP had the HP way, slow, thoughtful, run by engineers. Compaq, they were the polar opposite, fast, aggressive, sales-driven. It's like mixing oil and water, if the oil was also on fire.
Someone put it perfectly. That's not a merger. That's a collision course. And they were right. When you try to force two cultures like that together, you don't get teamwork. You get infighting, chaos, and nobody's focused on actually running the business anymore. The whole thing becomes incredibly fragile. Okay, so fast forward. The deal goes through. The dust settles. So what happened? What did ignoring those massive flaws actually lead to?
So first things first, let's give credit where it's due. You know those $2 billion in cost savings they promised? They nailed it. Absolutely hit that target. So on that front, mission accomplished. But that is only one part of the story.
Because remember that other kind of synergy, the revenue one, the dream? Yeah, that never showed up. It just vanished into thin air. And the fallout was brutal. Their market share gains evaporated. Employee morale absolutely cratered as the two cultures clashed. And you can guess what happened with investors. Trust in leadership just fell off a cliff. And maybe worst of all, they took their eye off the ball, off that golden goose printer business.
So what's the verdict? Well, pretty soon, everyone saw this deal not as a stroke of genius, but as a textbook case of how to destroy value. I mean, you could seriously argue that the new, bigger HP was actually weaker than the two separate companies had been before the merger.
So this whole story begs the question, right? What separates a train wreck of a merger from one that actually succeeds?
Let's get to the takeaway, because there are some timeless lessons here.
This table really lays it out perfectly. Look at HP and Compaq. The driving force was just scale, just getting bigger for the sake of it. Now compare that to some modern deals that worked. Microsoft buys Activision. Why? For the strategy. They needed content and IP for Xbox Game Pass. Or Dell buying EMC. Again, strategy. They wanted access to a whole new market. You see the pattern? Successful deals are driven by a sharp strategy, not just this vague idea of being bigger.
Okay, so if we boil this entire epic saga down, what are the big lessons? I think it comes down to three things. Number one, synergies look amazing on a spreadsheet, but they are ridiculously hard to achieve in the messy real world. Number two, culture isn't a soft issue, it's a hard issue. It can absolutely kill a multi-billion-dollar deal. And number three, and this is the most important one, strategy beats size. Every single time. Getting bigger isn't a strategy, it's just getting bigger.
So at the end of the day, the HP Compaq story is the ultimate cautionary tale. It's the perfect proof that in business, bigger is definitely not always better.
What you know gets me thinking. What's another one of these huge, dramatic business stories you'd want us to break down like this? Let us know what you think.